My name is Michael Grandi. I'm a professor at Providence College, and I'm teaching managerial accounting at Providence College. That's called ACC 204. And today's discussion is going to be on the topic of job order costing. And I'm going to be using the PowerPoint deck from the Kimmel, Queso book, which is Accounting, Tools for Business Decision-Making, 7th edition. So what I'd like to do is start that PowerPoint presentation, and I'll, as usual, add things to the conversation that may not be there, but to help illustrate what's happening. So let me pull up the PowerPoint presentation. I'll share my screen with you, and we can get started. Chapter 15, job order costing. Now, there's a lot going on here, but essentially what this talks about is the cost buildup of the manufacturing process of our product. And what we learned in the first chapter, chapter 14, talking about managerial accounting in this textbook, is product cost. And product cost included direct materials, direct labor, and manufacturing overhead. Remembering that a manufacturing company makes something from scratch, completes it, and sells it to the customer. We need to capitalize. We need to put all the costs of making our product on the balance sheet until we sell it. Let's remember the matching principle. The matching principle from financial accounting specifically says that you cannot expense the cost of your product until you sell it. So what that means from an accounting standpoint is as we incur all of these costs, as we incur the costs of direct materials, direct labor, and manufacturing overhead, those costs have to be captured in an inventory account until it's sold. So the stages of inventory that are important to us, again, balance sheet accounts, inventory accounts, are asset accounts, raw materials, work in process, and finished goods. And I've said it a couple of times that manufacturing overhead account is a temporary account that we're going to use to capture indirect materials, indirect labor, and other factory costs. The debits in that account are going to represent actual costs, and the credits to that account represent amounts transferred to work in process. There is oftentimes something left over. There's either a net debit or a net credit, and we'll see what we're supposed to do with that at a later date. But let's get started here. Here are our broad learning objectives. Number one, we're going to describe cost systems and the flow of costs in the job order system. Use a job cost sheet to assign costs to work in process. So we have two things going on here. We have general ledger accounts, which you're familiar with, also known as T accounts. And then we have job cost sheets, where we accumulate the cost for each particular job that we're working on. We're going to show you how to calculate predetermined overhead rates. We're going to talk a little bit about, we're going to skip pretty much learning objective. We're going to skip part of learning objective 4 as it relates to service companies. We'll talk about manufacturing companies, but we're going to skip the part on service companies. And then learning objective 5, that's when we're going to talk about what's left over in our manufacturing overhead account. So learning objective 1, we're going to describe cost systems and the flow of costs in a job order system. Cost accounting involves measuring, recording, and reporting product costs, direct materials, direct labor, and manufacturing overhead. These accounts are fully integrated into the general ledger system. There's two basic types of cost systems. One is a process order cost system, and the other is job order costing system. This chapter is about job order costing system. But very quickly, process cost system is pretty much simple because it's used when a large volume of similar products are manufactured. Cereal, ice cream, think about toothpaste, manufacturing a lot of the very same thing. Costs are accumulated for a time period, a week or a month, and costs are assigned to departments or processes for a specific time period. In essence, they're going to take the total cost of manufacturing, 100,000 tubes of toothpaste. So they take the total cost of manufacturing, that could be $1 million. And then they divide it by 1 million tubes of toothpaste. It costs them $1 to make it. Potato chips production, think about it. This is what it takes to process potato chips. But it's the same thing over and over again. Job order costing, on the other hand, costs are assigned to each job or batch. You may have job number 1, job number 2, job number 3, job number 4. More importantly, each job or batch has its own distinguishing features. The objective is to compute the cost per job. So the example that I like to use here when it comes to job order costing is, imagine a developer. A developer purchases maybe 10 acres of land. And this developer decides he wants to build houses on this land. You've all seen it. You've driven through some neighborhoods where a piece of land is sold. Maybe it's an old farm, and they buy a big patch of the farmland and they decide to build houses. So let's assume, for the sake of conversation, they're going to build 20 houses on this piece of land. And all of these houses are going to be somewhat different. Some of them are going to be bigger than others. Some of them are going to have hardwood floors and marble. Others may just have some carpeting and some carrene. So nothing very expensive. But what happens is the cost of each is different. So we want to keep track of each house. House number 1, what did house number 1 cost? What did house number 2 cost? Because they're going to be different. Again, the objective is to compute the cost per job or the cost per house. Measures cost for each job completed, not for a set time period. The illustration that they're using here shows the recording of cost in a job order cost system for Disney as it produced 2 different films. 2 different films. One's an animated film and one is an action thriller. So different costs go into different jobs. So you can see here, they have an illustration of job number 9501 versus job number 9502. Different costs, different amounts need to be kept track of. Cost accounting systems, job order cost flow. So again, we talked about this at the very beginning. When we first acquire materials, they go into an inventory account called raw materials. As we begin to use these materials and we start to work on it, it moves to work in process. So the definition of raw materials are untouched. The definition of work in process inventory is started but incomplete. The next stage of inventory is finished goods. That means the job has been completed. And then lastly, once the job is sold, we need to transfer the cost of that job to the cost of goods sold. And that's when we match the revenue, that is the sale of the job, to the cost of goods sold or the expense. And you can see here are some T accounts where we show the flow of costs going through the general ledger system. Here's an illustration. Wallace Company purchased 2,000 lithium batteries at $5 per unit, or $10,000, and 800 electronic modules at $40 per unit for $32,000, for a total cost of $42,000. The entry to record this purchase on January 4th is as follows. it goes into an inventory account called raw materials inventory. They purchased it on account. We have a credit to accounts payable. Accumulating manufacturing costs, factory labor costs. Okay, these are the wages and salaries and benefits of employees working in the factory. You get the gross earnings, the employer payroll taxes, and then any fringe benefits that may incur to the employees. Here's another example. They incur $32,000 of factory labor costs. Of that amount, $27,000 relates to wages payable and $5,000 relates to payroll taxes payable. The entry to record this is a temporary account called factory labor, which we can classify as a balance sheet account, but as you're going to see, that's a very temporary account. We're going to close it out. We have a debit to factory labor in these two payable accounts. Manufacturing overhead costs, many types of overhead costs, property taxes, depreciation, insurance, repairs related to the manufacturing process, more specifically relating to the factory. Costs unrelated to manufacturing are expensed. Those are typically period costs. They are non-manufacturing costs, generally fall into the category of selling and administrative expenses. Costs related to the manufacturing process are accumulated in the manufacturing overhead account. Again, manufacturing overhead account is a T account, a general ledger account. It's classified as a balance sheet account, and the debits in that account represent actual costs. And as we're going to see, the credits represent amounts transferred to work in process. Another illustration. Using some assumed data, the summary entry for manufacturing overhead in Wallace Manufacturing is as follows. So rather than debiting utilities expense, insurance expense, repairs expense, depreciation expense, all of these costs that are associated with the factory are debited to manufacturing overhead. Same thing with property taxes. During the current month, Ringling Company incurs the following manufacturing costs: raw materials purchased, factory labor, which is $15,000 in wages, $3,000 in payroll taxes, factory utilities, factory insurance, etc. Prepare the journal entry. For the raw materials, it goes into an inventory account, specifically raw materials inventory. For the wages, I'm going to debit that temporary account called factory labor and credit the two payables. Factory utilities, $2,200. Factory insurance, $1,800. Depreciation on factory building. Again, these all go into manufacturing overhead. We talked about this in chapter 14 as we discussed managerial accounting, and specifically anything that's factory related goes into manufacturing overhead. Use a job cost sheet to assign costs to work in process. So a job cost sheet is a subsidiary ledger, if you will, where we capture the costs assigned to each job. Used to record costs chargeable to a specific job. Job 1, job 2, job 3, job 4. Now, many job sheets look different, but what's being captured here? Upper left-hand corner, the job number, some identifying factor. Job 1, job 2, job 3, job A, job B, job C, whatever you want to call them. The quantity up in the upper right-hand corner is the number of units. And the next section is where they keep track of the postings that are going on for materials, labor, and overhead. And then the bottom, we have a summary, which is our product cost. Direct materials, direct labor, manufacturing overhead, total cost. And then in order to come up with the cost per unit or the unit cost, we take the total cost divided by the number of units. Raw materials costs are assigned to each job. You can see in this particular example, this is a materials requisition slip. You're not going to see a lot of this on a test, but it's just some detail where they took $1,000 worth of raw materials for this particular job. Wallace uses $24,000 of direct materials and $6,000 of indirect materials in January, as shown. So what are we doing here? We're transferring materials out of raw materials inventory, right? It's an asset. To increase an asset, you debit it. To decrease an asset, you credit it. They are decreasing raw materials inventory, but they are increasing work in process for direct materials, and they are increasing manufacturing overhead for indirect materials. And that's what the 2T accounts look like. This is what our subsidiary ledgers look like. I wouldn't be too concerned about this. You won't be seeing something like this. Factory labor. Again, this is the wages and salaries of employees who work in the factory. Is assigned to jobs on the basis of time tickets or time clocks. Time tickets are prepared when work is performed. Time tickets indicate the employee, hours worked, account and job charge, total cost. So this is a time ticket for this particular employee. He worked 4 hours at $10 an hour on this particular job, job number 101 for $40. The time tickets are later sent to the payroll department, which applies the employee's hourly wage rate and computes the total labor cost. If the $32,000 in total factory labor consists of 28 in direct labor and 4 in indirect labor, here's the entry. Remember, by definition, direct labor goes into work in process, and indirect labor goes to manufacturing overhead. And here's what we've done, right? We've cleaned out that factory labor account, didn't we? In a previous entry, we debited it. Here, we credit it, it zeroes out. This is posting of materials. Posting materials journal entry. Here's the posting of labor. Again, work in process. The debits in work in process. Direct material, direct labor, manufacturing overhead applied. The debits into manufacturing overhead. Indirect materials, indirect labor, other factory costs. Danielle Company is working on 2 jobs. The job cost sheets show the following. Direct materials for job 120 and job 121. Direct labor for job 120 and 121. And then manufacturing overhead for job 120 and 121. Prepare the 3 summary entries to record the assignment of these costs to work in process and on the job cost sheets. So this is for the requisition of materials, specifically direct materials. Here's for the recording of direct labor. And here's for the recording of manufacturing overhead, which is traceable to these jobs. So learning objective number 3. How to calculate the predetermined overhead rate. So manufacturing overhead costs relate to production operations as a whole. Cannot be assigned to specific jobs based on actual costs incurred. So we have no way of tracing or identifying manufacturing overhead to each particular job. So we need to find some other way of assigning or allocating overhead to job 101 versus job 102 versus job 103. Companies assign to work in process and to specific jobs on an estimated basis through the use of a predetermined overhead rate, PDOR, based on a relationship between the estimated annual overhead costs and the estimated operating activity. That operating activity, that activity base, that cost driver, that denominator value can be almost anything, but usually direct labor hours or machine hours. We're going to see some examples where they use direct labor dollars. The predetermined overhead rate is established at the beginning of the year. Small companies often use a single company-wide predetermined rate. Large companies often use different rate for each department. Here's the formula. You want to commit this formula to memory. Total estimated manufacturing overhead dollars or costs divided by the estimated annual activity. Manufacturing overhead dollars divided by activity base equals the predetermined overhead rate. Manufacturing overhead costs are assigned to work in process during the period to get timely information about the cost of a completed job. The actual, so this is going to be the manufacturing overhead applied to a job equals the predetermined overhead rate times actual activity. Let me repeat that because it's not very clear here on this slide. Manufacturing overhead applied or allocated to a particular job equals the predetermined overhead rate times the actual activity. Now that actual activity can be direct labor hours, can be machine hours, or it could be direct labor dollars. Here's an example. Wallace Company uses direct labor cost or direct labor dollars as the activity base. Assuming that the company expects annual overhead costs to be $280,000 and direct labor costs for the year to be $350,000, compute the rate. So it's the manufacturing overhead dollars divided by the activity base, in this case, labor dollars, equals the predetermined overhead rate. So they estimated $280,000 of manufacturing overhead and $350,000 of direct labor cost. So the predetermined overhead rate is 80% of the direct labor cost. And that's what that says. For example, Wallace applies manufacturing overhead to work in process when it assigns direct labor costs. Calculate the amount of applied overhead assuming direct labor costs were $280,000. Pardon me, $28,000. So $28,000 in direct labor costs. The predetermined overhead rate is 80% of direct labor. Therefore, manufacturing overhead applied is going to be $22,400. So we're going to transfer some money out of manufacturing overhead and into work in process. So we're going to increase the work in process account and decrease manufacturing overhead. So the following entry records the application. So these two accounts are very important. We're going to track them very closely. On the left-hand side, you've got the manufacturing overhead account. The debits in that account represent actual costs for indirect materials, indirect labor, and other factory costs. The credits in the manufacturing overhead account represent amounts transferred to work in process. You can see in this case for manufacturing overhead, there's something left over. $1,400 of a net debit left over. We'll talk about that later. On the right-hand side, you see the work in process account. Work in process account, you got $24,000 that represents direct materials. You got $28,000 that represents direct labor. And now you have $22,400 that represents manufacturing overhead applied. Again, manufacturing overhead applied equals the predetermined overhead rate times the actual activity. In this case, the predetermined overhead rate was 80% of direct labor. Direct labor was 28,000. The resultant number, 22,400. There's the journal entry to record it. So this is where they posted applied overhead to each particular job. So you can see on the left-hand side, you got job 101, job 102, job 103. You also see for job 101, there's direct materials of 12,000, direct labor, 15,000, manufacturing overhead of 12,000, total cost, 39,000. They have job 102, again, product cost for each job, direct materials, 7,000, direct labor, 9,000, manufacturing overhead, $7,200, total cost, 23,200. If you look at all the manufacturing overhead, you got 12,000, 7,200, 3,200 for each job. It will add up to that third entry for 22,400. Check the work in process and job cost sheet at the end of each month. Balance in work in process inventory should equal the sum of costs shown on the job cost sheets of unfinished jobs. So you got jobs 101, 102, and 103, which came from the previous sheet, 39, 23,2, and 12,2. And that's the amount that you have in work in process. They should equal each other. Stanley Company produces specialized safety devices. For the year, manufacturing overhead costs are expected to be $160,000. Expected machine usage is 40,000 hours. The company assigns overhead based on machine hours. So this is a little different. In the previous example, they assigned manufacturing overhead as a percentage of direct labor cost. In this example, they apply manufacturing overhead based on machine hours. Compute the predetermined overhead rate. Again, total estimated overhead divided by the activity base, or the activity, $4 per hour. Goes on to say, the company assigns overhead based on machine hours. Job 302 used 2,000 hours. Determine the overhead to be allocated or manufacturing overhead applied. Actual activity, 2,000 hours. Predetermined overhead rate, $4 per hour for $8,000. Stanley Company, and it says again, prepare the entry to assign overhead to job number 302. There's the journal entry. You calculated $8,000 of manufacturing overhead to be applied. That's the journal entry to do it. Prepare entries for manufacturing and service jobs completed and sold. Assigning cost to finished goods. When a job is completed, you have to move it to finished goods. Wallace Company summarizes costs and completes the lower portion of the applicable job cost sheet. So they have completed this job. Job number 101 is completed. They made 1,000 units. On the bottom right-hand corner, they summarize product cost. Direct materials, 12,000. Direct labor, 15,000. Manufacturing overhead, 12,000. Total cost, $39,000. They produced 1,000 of them. Cost per unit, $39. When a job is finished, Wallace transfers the cost to finished goods inventory. One inventory account goes up, the other one goes down. The only way you know how to come up with the $39,000 is by keeping track of the cost. This is what the 2T accounts look like. On January 31st, Wallace sells on account job number 101. The job cost $39,000. Recording the sale, as follows. Well, they didn't tell you what the sales price was, but they are now. Obviously, $50 per unit, 1,000 units, $50,000. Record the sale. But exactly the same time, you need to record the expense. It's the matching principle. You're matching revenue and expense in the same accounting period. Gross margin is what? $50,000 in revenue minus $39,000 in cost of goods sold. Gross margin on this job, $11,000. This is how the cost flows move. Raw materials to work in process to finished goods, cost of goods sold. We can skip that for a minute. I'm going to skip the service contract materials here. I'm going to skip this example. Okay, so we talked earlier about the manufacturing overhead T account. And the debits in that account represent actual costs. The credits represent amounts applied to. There's often a difference. There's something left over. There's either a net debit or a net credit. So we need to distinguish between underapplied and overapplied manufacturing overhead. A debit balance in the manufacturing overhead account means that overhead is underapplied. Remember, the debits in that account represent actual costs. The credits represent amounts transferred to our product cost account, work in process. If we have a net debit, that means we have some cost left over. That means we did not transfer enough cost into our product. Hence, it's underapplied. On the other hand, we could have a credit balance in the manufacturing overhead. And that means we put too much cost into our product cost, work in process. That means we overapplied. What do we do with the difference? Underapplied or overapplied manufacturing overhead at any year-end balance and manufacturing overhead is eliminated by adjusting the cost of goods sold. Now, I would say that you want to do it at least quarterly, because if you're issuing quarterly financial statements, you want to clean up this account. Here's an example. This is the example we're working with. So in this account, this was Wallace, the manufacturing overhead account. They had $13,800 in indirect materials. They had $6,000 in indirect labor, and they had $4,000 in other factory costs. Those were actual costs. They only transferred out, as you recall, $22,400. That was 80% of the direct labor. They got $1,400 left over. Wallace has a $1,400 debit balance in manufacturing overhead at December 31st. The adjusting entry to the underapplied overhead is as follows. So you want to zero out manufacturing overhead. If you have a net debit, that means you're going to credit it for $1,400. And you know from financial accounting, your journal entries, you need to have, your debits have to equal your credits. You need a debit to the cost of goods sold. In other words, we increase the cost of goods sold by $1,400, and that's what this account does. We had a gross margin of $11,000 on this job, $50,000 of revenue, $39,000 of cost of goods sold. We had $11,000 of gross profit, but we just added another $1,400 of cost, reduced our gross profit down to $9,600. Another example. Car company, the predetermined overhead rate is 140% of direct labor cost. During the month, Carr incurred $90,000 of factory labor, of which $80,000 is direct labor, right? The overhead rate is based on direct labor, and $10,000 in indirect labor. Actual overhead incurred was $119,000. Compute the amount of manufacturing overhead applied during the month. Determine the amount of under or over applied manufacturing overhead. Manufacturing overhead applied, right? 140% of direct labor dollars, 112. The under applied. The actual costs, the debit in the manufacturing overhead account was $119,000. The credit, manufacturing overhead applied, the amount transferred to work in process was $112,000. They have a net debit of $7,000. They had cost left over. They did not transfer enough actual cost into their product cost account. So we're going to see some examples in our practice problems. We'll take a look at those. Thank you. Talk to you soon.